Hello and welcome to Smart Money. I'm Alishia Seckam, and today we're getting investment insights from one of the country's top 3 wealth managers as ranked by South Africa's Intellidex Top Private Banks and Wealth Managers Awards, Brian Butchart. He's Managing Director of Brenthurst Wealth, and with this access to you, Brian, I'm not going to labor the intro here. Instead, I want to get straight into where and how the smart money is being put to work right now. Before we do that, credentials matter, right? Because it's not just you wearing that crown for several years running. Brenthurst itself has been recognized as the leading boutique wealth manager in South Africa for 7 consecutive years as well. And that's quite the recognition. Does recognition like that matter?
Hi, Alicia, and thank you. Intellidex provides a detailed report and a survey based on client and peer reviews. And the feedback from clients and market insights provides an opportunity to focus on how we can improve our offering. And that we think is very valuable. Although we appreciate the recognition, what's more important is the endorsement from our clients based on relationships built on trust and service delivery. And it's not one individual, it's a collective contribution of the people in the business.
So, as far as financial advice and services goes, what would you say the value proposition is that Brenthurst puts on the table for its clients that differentiates you from your competitors?
Alicia, Brenthurst is founder managed, privately owned, and not dictated to by a larger corporate focused on flows. We spend a significant amount of time conducting our own research and consulting externally to a number of financial professionals to develop our investment strategy and have full flexibility where to invest. Clients, we think, value that independence.
Absolutely. And I mean, the company manages a whole lot of billions on behalf of its clients, right? It's got a strong focus on investing offshore, and that's been for the longest while. You've gone against the trend. Over the past few years, though, a higher offshore allocation trend seems to be echoing across the financial services industry, Brian. Are you seeing the trend shift significantly, or do you still see yourselves as the outlier here?
Alicia, Brenthurst has been recommending offshore allocation for more than a decade. And initially, it was to gain access to investment opportunities not available in South Africa. The technology sector is just one example, which has been the best performing sector over the past 10 years, albeit more volatile than more diversified indices. And over that period, we became concerned about the mismanagement of the South African economy and the flow of foreign capital out of South Africa, thereby increasing our offshore allocation further over the past 5 years alone. There's been a net outflow of about 1.5 trillion rand from our bond and equity markets by foreign investors, and in our view, indicating a lack of confidence in South Africa. We've had numerous downgrades by ratings agencies, and we've been grey listed. And the IMF just this week downgraded South Africa's growth forecast to 1% on the back of impact of rolling power cuts and bottlenecks at ports and railways. The JSE All Share Index has also shrunk from approximately 800 quality listed businesses in 2001 and now down to less than 300 as larger corporates have exited, opting for far more attractive investment destinations with far less risk. And we think the same applies to investment opportunities with far greater optionality. We've also seen a decline of about 7% in the rand versus the dollar over the last 15 years. And investors who invested offshore over the last decade fared far better than those that only invested locally. And I did some numbers. I mean, I had a look at the MSCI All Country World Index, which is basically the global equity market in each respective market in the respective weightings versus the JSE All Share Index. And in dollar terms, you did over the last 10 years, 8% in dollars annualized over the last 10 years versus the JSE at about 3%. So that's about a 5% difference in dollar returns over a 10-year period. And in rands, there was a similar kind of scenario where I think you achieved about 14% in rand terms annualized over 10 years versus about 8 or 9%, I think it was, on the JSE All Share Index. Yeah. And we think that's probably going to continue.
Yeah, so there's a whole lot of data, Brian, that, supports the investment strategy you guys pursue, right? I've got to ask, does Brenthurst invest locally at all?
We do. And I think that is a misperception. I mean, if I consider our offshore versus local asset allocation, in our AUM, our assets under management, we have approximately 60% invested offshore, so it is on the higher end, with the remaining 40% invested locally. And I mean, this of course differs from client to client depending on personal circumstances. Some will have a higher offshore allocation, while others will have a lower allocation, because we have to consider income requirements and individual risk profiles and investment objectives. If I break down the allocation further, I mean, approximately 10% is invested in local equities and 30% invested in local income funds. Our exposure to local equities is predominantly within Regulation 28 funds. That would be your provident, pension, and retirement annuities. Due to the limitations of offshore allocation, while we've preferred income funds locally, which provided attractive yields at a far less risk than the JSE and delivered either better or similar returns.
Yeah. Like you say, I mean, we do have Regulation 28 restricting funds, right? So, as much as you're advising investors to reduce their exposure to South Africa because the economy is simply not delivering the growth needed to secure a comfortable retirement, we've got that regulation to keep in mind, whether we're looking at pension, provident, or retirement annuities, as you say, in terms of that offshore allocation. What, if any, solutions, Brian, could these products could see these products, I guess, gain a higher offshore exposure?
Alishia, as you point out, I mean, unfortunately, Regulation 28 restricts offshore allocation to 45%. However, we've identified a solution using a Regulation 28 compliant fund, effectively a balanced mandate, which minimizes, or should I say maximizes, their offshore allocation to 45%. And by carefully selecting Rand hedge stocks on the local market, in terms of the local exposure, they can indirectly increase their offshore allocation to as much as 90%. So that does help, and it has, however, been more volatile as a result. And it is explained to clients looking for a higher offshore allocation in the retirement funding, and it's not for everyone. But the fund delivered a 48% return last year. Of course, 1 year is a very short period of performance, and generally markets did quite well last year. But over the 5 years since inception, it delivered a 13.68% return versus the benchmark of 9.35%. So quite a substantial difference.
Yeah, because we've got to admit, right, the world is big. It can sometimes be intimidating as well, even if we've got technology making it seem smaller. So how does Brenthurst identify, for one, investment opportunities considering the size of global markets, and then two, compete on the global stage considering, Brian, the number of asset managers that are in play?
Alishia, it's massive. There's so many options in terms of investment opportunities abroad. I mean, we're talking thousands upon thousands of asset managers, and then of course they have the individual funds as well. So the number just gets staggering. But we have an investment committee headed up by our investment strategist, Magnus Haystack, with senior internal and external committee members for a diversity of views, which meets every quarter. And we consult with multiple external independent economists, discretionary fund managers, and political analysts, as well as conduct our own research. And from that, we kind of derive our own house view in terms of where we should be allocating money on behalf of our clients.
I'm going to put you on the spot here, if I can. What investment opportunity is blinging bright on your radar screen right now on the international scene?
And look, Alishia, I mean, if I consider what's happened over the last couple of years, and I actually watched the Fed's speech last night, Jerome Powell, who was touching on interest rates and whether they're going to be reducing that. And obviously, considering the market environment at the moment and looking at what happened last year, I mean, last year was an unexpected, very, very good return in terms of global markets versus the year before in 2022. Especially as interest rates were elevated. It wasn't necessarily expected by many. But most of that return came from the Magnificent Seven, so all the big tech stocks. So if you have a look at the underlying US market and exclude the Magnificent Seven, the broader US market actually didn't perform very well. And there could be some opportunities within that as interest rates start coming down, because there is an expectation that should start happening during the course of this year. But more than that, also other geographies. I mean, we've identified Japan as one of the regions that we've been putting more money into. And then, Europe is also offering some opportunities. And then China, albeit a little bit more risky, they are very, very well priced at the moment.
Yeah, I asked that question, Brian, because, we talk about the global economy finding its feet again after COVID hit output and growth. Once we see the halting of interest rate increases, I mean, in fact, late last year already, that, as you say, being seen as a turning point in the cycle, and then attractively priced opportunities surfacing for investors seeking higher yield as those interest rates start to decline again. But then you come up against major geopolitical risk, right? Whether you're looking at Russia, Ukraine, Israel, Palestine, China, Taiwan for that matter. We've got multiple elections coming up in 2024 as well. And that all potentially presenting significant risk that could change any forecast we put on the table right now. But 1 month in, how are you feeling about 2024?
Look, Alicia, I mean, I must say it's some very valid points that you raised there. And I think there are headwinds, and one has to be aware of that. So you don't necessarily want to deploy new capital into equity markets just yet. Obviously, if you are invested, I would stay there. I wouldn't move out of the market. But with new capital going into the market right now, there are risks, and one has to be aware of those risks. And one mustn't forget that at the current interest rates as high as they are, earning 5.5% in a money market fund, or even an income fund that obviously uses bond instruments offshore, are yielding about 6.5% in dollars. That's a very attractive return at the moment with very little risk, or far less risk than in the equity market. So one could obviously deploy that type of strategy in this environment right now and see how this plays out over the next 6 to 12 months in terms of where the interest rate cycle is going. But we do think at some point when that turns and it starts coming down, there will be an opportunity to get back into the market.
Brian, it's been a pleasure catching up with you today. Thanks so much for your time and sharing your perspectives with us as well. Brian Butchart is Managing Director of Brenthurst Wealth.